Hello and welcome to today's webinar on pension transfers. My name's Lisa Webster and I'm one of the senior technical consultants here at AJ Bell. So here's what we're going to look at today. I'm going to start with a quick recap of common reasons to make a pension transfer. Then I'll have a quick look at the basics regarding DB defined benefit transfers. I'll spend a bit more time looking at drawdown transfers and points to consider before we look at some of the nuances of block transfers and when the statutory permissive override might come in handy. We'll then move on to cover potential issues with protection and transfers. Then I'll be looking at the cheerful subjects of death, divorce and ill health and considerations when transferring following each of these events. And then we'll finish off with a look at overseas transfers and finally what's changing in terms of the statutory right to transfer, which is all to do with the fight against scams. So starting off then, looking at the reasons to transfer. I'm not saying these are all the reasons, but you know, it's just sort of, I'm sure, a brief recap for most of you on some of the reasons why people might want to transfer their pension. First of all, we have things like for investment choice, wider range of investments they might have with this provider, their current provider. Benefits obviously is a big one to access pension freedom, sort of flexibility of benefits to be able to take them in a way they can't under their current scheme. Death benefits, again, very common to have access to more freedom in terms of how death benefits can be distributed. Customer service, still up there as one of the reasons if you're not happy with the customer service where the client is. Fees, could be somebody's changing job, and so you know, otherwise you can end up with lots of pension schemes all over the place. People move jobs and you want to bring it together, joining new schemes with their new employer. A requirement for flexibility, that's meant to represent, it doesn't mean you have to do yoga. So it could be flexibility not offered by your current provider, it could be online functionality, you know, as well as things regarding, you know, how benefits are taken, etc. Consolidation is another common one. You know, if people have got pension schemes all over the place, that can be quite difficult to manage. It can be much more efficient to have everything all together in one place. So we have people whose pension schemes are being closed, so they may be forced into a transfer, or you know, if they want to leave it in a closed scheme, or they might not like where the whole scheme is being transferred to, and so you might want to go in a different direction. We also occasionally see the opposite of consolidation. We see fragmentation, where people wish to spread their risks. Some people are particularly risk averse, so they don't like the idea of having too much money with one provider, and they want to split it out. Probably less common, but it's still possible. You know, some people do use those reasons. And the final one I've got on there is, you know, if somebody moves overseas, they want to take their pensions with them, so they don't have exchange risk and things like that to worry about, amongst other reasons. So plenty of reasons for people wanting to transfer their pensions. Obviously, when it comes to defined benefit transfers, we have extra restrictions in place, as I'm sure you're all aware, where that if there are safeguarded benefits within a pension scheme of £30,000 or more, and that is not just defined benefits, also includes guaranteed minimum pension, GMPs, and guaranteed annuity rates, GARs. If the total value of those safeguarded benefits is, say, equal to or greater than 30,000, then there is a requirement for the client to take financial advice before they can make that transfer. The trustees will ask for evidence of that before they allow the transfer out, and obviously the advisor firm, if you are advising on DB transfers, safeguarded benefits, needs to have the permissions, the appropriate permissions to do so. We have actually got changes that have come in recently from the 1st of October on the contingent charging ban. That is in place now, but there are some transitional arrangements if advice process started before the 1st of October. Also now, well, we've had for a long time the position that the default, your starting point when advising has to be not to transfer, and you have to sort of, you know, start from that basis point and then prove otherwise. But also now the default position for any defined benefit transfer or those with safeguarded benefits will be to go to a workplace pension And if the transfer isn't going to the workplace pension, then you have to demonstrate why whatever you're recommending is more suitable than that. We have seen a huge drop in DB transfers. I'm sure there's a few of you who will be listening to this who used to advise on DB transfers and no longer do. Obviously there'll be a few of you that still do, some of you that never have, but yeah, there has been significant drops in the amount of transfer activity, and the XBS pensions groups, their transfer activity index, it fell to a record low in September, even lower marginally, but even lower than we had in April in the immediate aftermath of sort of the full-on lockdown and coronavirus. So yeah, big drops in this area. If you do want to know more about DB transfers and in terms of the new rules that we have in place now, a lot more detail on it, my colleague Rachel Fay did a webinar on this a couple of months ago, which is still available on our website, and I'll show you at the end exactly how you can access that, where you can find that, but that goes into a lot more detail in DB transfers. If that is an area you're still working in and you're interested in, then I would recommend that you watch that one. I'm not going to go into any more detail about it today. What I will carry on and talk about is drawdown transfers next. So generally speaking, when it comes to any transfers, pension transfers, they have to be on a like-for-like basis. So uncrystallised transfers will go from an uncrystallised fund to an uncrystallised fund. Drawdown will have to go to drawdown. If you have somebody that is in capped drawdown under their original scheme and you're doing a transfer, it will be on a like-for-like basis. They will go to capped drawdown in their new scheme. They can immediately convert that to flexi access drawdown. They don't have to, but that is quite common to happen. It can be converted on transfer, but technically speaking, it does go across as capped to capped. It's just that it's immediately converted. If that's what you want to do, you don't have to. Transfers, can consist of uncrystallised and crystallised funds. So if you've got a scheme, the original scheme that's partially crystallised, that's no problem. But the important thing to note is that crystallised funds cannot be split upon transfer. And when you transfer crystallised funds, drawdown funds, that they have to be designated to a new arrangement in the new scheme. So even if you're transferring to a scheme that you've already got crystallised funds in, so you've got scheme A that's got a flexi access drawdown fund, scheme B also has a flexi access drawdown fund, you can't transfer them and merge them into the same arrangement. They have to go into separate arrangements. You can transfer uncrystallised funds into a new scheme. It comes across uncrystallised to uncrystallised, then immediately crystallise it into that existing drawdown arrangement. But say if it's already crystallised in one scheme, when it comes across, it has to go into a separate arrangement in the new scheme. That's really a legacy issue. Obviously, when everybody was operating on cap drawdown, or USP before that, and obviously when we have to do reviews, you could see the need for having separate arrangements because you had to calculate the maximum income that could be taken, and it gets very messy if you start merging arrangements. So arrangements had to be kept separately. With flexi access drawdown, you can't really see the argument as to why you have to do it. There's a lot less need for it. But the rules are still there. I think it's a bit of a legacy issue, so they do have to be kept separate. So that's worth remembering. If that wasn't clear, which is quite possible, I've got some diagrams which hopefully explain, what you can and can't do, and then we'll look at sort of why it's important, this sort of what we do with arrangements on drawdown transfers. So here we have scheme A. So this is your existing scheme, which we have a partially crystallised pot. So we've got the green representing the uncrystallised funds and the red the crystallised funds. Obviously you can move that if you decide you want to do a transfer. You're transferring it to scheme B, which is a new scheme you've just set up. Obviously the simplest thing to do is to move the whole lot and it'll come across, it'll look exactly the same. You've got one crystallised arrangement, the rest of it's uncrystallised. Very straightforward. In terms of partial transfers, if you wanted to, you could just transfer the uncrystallised pot. That's absolutely fine. If you wanted to, you can split that element if you needed to. You can also move just all the uncrystallised funds, and leave a bit of the crystallised, leave the uncrystallised funds behind. That's allowed. So you can do all the crystallised and you can split the uncrystallised if you want. That's absolutely fine too. But the only thing that the key part that you need to remember here is that you can't split your crystallised pot. So you can't just take a chunk of your crystallised and move that to scheme B. That's not allowed under the rules. Question might be, why would you want to do a partial transfer? As I mentioned earlier, it's possibly for diversification reasons. Not that common, but it is possible. What we do see from time to time is illiquid investments. There may be some investments that you have in one scheme. You have plenty of other reasons why you want to move out of that scheme, but because you have a bit of an illiquid investment, or you have an investment that the scheme you're transferring to doesn't accept, that you may want to do a partial transfer because you have to leave a little bit of it behind. So that's fine if it's uncrystallised, but say you just can't split the crystallised pot. That's the important part. Looking now at a slightly different scenario. So we still have scheme A, looks like it did before, partially crystallised, but also we have scheme B. Now scheme B here, you've already got that set up. So this is somebody who's got two pension schemes open. Scheme A is partially crystallised, scheme B is fully crystallised, and you're wanting to do a consolidation exercise, and you've decided you get your preferred provider is under scheme B, so you want to move everything across so it all sits in scheme B together, so you're wanting to move the whole lot. Now, you might be just doing this, say, if it's purely a consolidation exercise with no further crystallisations. What would happen is that would all come across and you'd end up with scheme B looking something like that. So you would have your uncrystallised element still, you would have a chunk that was crystallised in scheme A, and you'd have a bit that was crystallised in scheme B. You can't merge those two crystallised bits because they've been crystallised under different schemes, so they have to stay in separate arrangements. So that's what that will look like. Another scenario, again, same starting point as before, but let's imagine at the same time, once you've moved everything across, you want to fully crystallise all the benefits once it's moved across into scheme B. At that point, you have a choice because the uncrystallised transfer is coming across uncrystallised to uncrystallised. You have an arrangement which was originally crystallised in scheme A that keeps separate, and then you've got your crystallised funds in scheme B. At the point, once you're all in scheme B, you choose to crystallise the extra funds. You can choose which arrangement it goes into, or the administrator, or with the administrator, you can choose which pot it goes into. So on the first example here, this would be if you crystallised everything into the arrangement originally crystallised under scheme A. So they're looking sort of half and half, something like that. The alternative would be if you crystallised into the arrangement that was originally crystallised under scheme B, and then you'd end up with something that looks like that. Another thing to remember on this is because whenever you do a drawdown to drawdown transfer, it has to stay in a new arrangement under the new scheme you end up in. It means you can end up with lots of different arrangements if you do lots of crystallised transfers in. You can end up with several of them. Another point to note is that if you have any pre-AD drawdown funds, so funds that were originally crystallised on or before the 5th of April 2006, you can never add to those funds post-AD. So even if that was in this example scheme B, then you wouldn't have the option of adding to it. You'd have to keep those separately. Question you may be asking is, well, what does it matter which arrangement it goes into? Does it make any difference? Well, how much difference it will make will depend on the circumstances. Some providers may ring fence each arrangement, so you have separate investments under each arrangement. So when you're, trying to take income, you'd have to disinvest within that arrangement if you're taking income from that arrangement rather than sort of across the board. Others, like Investcentre, we just notionally earmark. So, your investments aren't split. It's just a notional, and then depending on when you draw down, that will change that notional split between the arrangements. The other point is for people that have lifetime allowance issues, because at age 75, so your drawdown funds, anything that's still in drawdown on the 75th birthday, get tested again against the lifetime allowance, and each arrangement gets tested separately. So you don't want to have sort of like surplus funds in one and then a deficit in the other for the lifetime allowance test, which hopefully that will make more sense on the next slide if I explain that. So if you have somebody who has two arrangements within their scheme, and on their 75th birthday, under arrangement A, their fund value is £10,000, and under arrangement B, they have £1 million. But under arrangement A, the amount they put into drawdown was originally £110,000. So it's only worth 10,000 now, because presumably that's, hopefully that's not investment loss. Hopefully that is because they've been drawing down funds from that pot. And then when you look at arrangement B, they only actually put 900,000 into drawdown originally, whenever it was, and these aren't weighted for time or anything. It's just whatever the figure, however long ago it was that was put into drawdown. So they put 900,000 to drawdown, but that fund's had some growth on it. So that's now worth £1 million. So when you get to age 75 and you do the test, you look at arrangement A and you look at that test and go, okay, the fund value is £10,000. Then you get a credit for the amount you originally put into drawdown, which in this case will be £110,000. So you've got effectively minus £100,000. But it doesn't work like that. It's just cancelled out. You just have zero. So there's nothing there to be tested against the lifetime allowance at age 75. That's absolutely fine. But when you look at arrangement B, you've got amount originally put into drawdown was 900,000. Your fund value is now £1 million. You've got 100,000 that's going to be tested against the lifetime allowance. And the fact you've got 100,000 spare in arrangement A doesn't help you. So that's the reason you need to be a little bit careful with the transfers, which pots you're putting into, and obviously when you're drawing down, you'd want to draw down across the arrangement so you didn't end up in that scenario if somebody didn't have sufficient lifetime allowance to cover it. So just want to be aware of on that. Moving on then to block transfers. Actually, I think I might have just skipped, sorry about that, just a bit fast there. So when it comes to block transfers, this is for people with scheme-specific entitlements to protected benefits that arose before A-Day. So before they had to have the entitlement on 5th of April 2006, and that would have been either a lump sum entitlement of more than 25% of the fund, or a protected retirement age of under 55. So there was a prescribed list from HMRC of prescribed occupations which had this right. Most famously footballers who could retire at age 35, such as our 2006 World Cup squad there, would all have been entitled to that under their scheme at A-Day. And generally these rights are lost when you do a transfer unless they do a block transfer. So entitlement, as long as they stay in the scheme that they're in, then they can keep that right to either more than 25% of the fund as a lump sum or an earlier retirement age. But with transfers, you have to be very careful with these. So the basic block transfer rules then. So you have to have 2 or more members transferring from the same transferring scheme to the same receiving scheme. So from scheme A to scheme B. Now, both members don't have to have something to protect. So it doesn't mean that both of them have to have a protected lump sum or both of them have to have a protected pension age. You could have one that has the protection as long as they're coming across with somebody else from scheme A to scheme B, then that is fine. It has to be all of the sums and assets in the transferring scheme. so no partial transfers, it's all or nothing. Has to be in a single transaction. So it doesn't mean that both members have to transfer on exactly the same day and all assets have to be assigned on exactly the same day. So that would be quite difficult to achieve, especially if you're doing an in-specie transfer. It just means it has to be part of the same agreement. So, you know, when the instructions come in, you know, to your new scheme, we're going to do this transfer. It's for both these members. They're both coming from this scheme, you know, all documented, all together. It's coming across. This is one transaction. The paperwork relates to both of them. Neither member can be have been a member of the receiving scheme for more than 12 months prior to the date of the transfer coming across. And that is scheme, not arrangement. We do sometimes get asked about this, where somebody's had a SIP with us for some time and then they want to do a block transfer. Like, okay, they've already had the SIP set up for more than 12 months. Can they just open another SIP with us, you know, another Investcentre SIP? And the answer is no, it doesn't work, because it's still the same underlying scheme. You just say each member has a separate arrangement within the same, it's the same pension scheme with the same PSTR number. So it doesn't work. It is at scheme level on that one. For a couple of things to remember with block transfers, if somebody is making multiple block transfers, then the protection is only retained in respect of the first transfer. So what I mean by that is, if, say, for example, somebody has protected tax-free cash under 2 schemes, you're wanting to consolidate those both, bring them across as block transfers into a SIP. You have got, you know, 2 members from the first scheme to come across to the SIP. So you meet block transfer requirements, that comes across, that's fine. That one will retain the protected tax-free cash. But if the same member then wants to do a transfer from his other scheme that has the protected tax-free cash, you've got another member to come across, whatever, you still do it within 12 months of the SIP being opened. That second transfer in, even if all the other conditions of block transfer were met, it wouldn't retain its protection. You can't get it twice. It's only the first transfer in that's going to retain that protection. When it comes to taking benefits, where you've got scheme-specific protection that you've retained following the block transfer, that all the benefits have to be taken at the same time. So there's no partial crystallisations. Of course, what you could do is you could have somebody who did a block transfer. They could take their protected PCLS, for example. So you don't have to take any income, they could just take the tax-free cash. They could then make contributions or have other transfers come in after they've crystallised. They wouldn't have to take them, they could then just take those as normal at a later date. That would be fine. But at the date of the actual crystallisation, where you're making use of this enhanced benefit, protected lump sum, or protected pension age, taking it early, you have to crystallise everything that's in the pot at that point in time, even though you can add uncrystallised funds to it later. In terms of those with a protected retirement age that could retire before age 55, there did used to be a bit of an issue with this with transfers. So, for example, one of our footballers who had a protected retirement age of 35, if they had used that, started taking benefits from another scheme, then done a transfer which wasn't a block transfer, they couldn't carry on taking benefits. Thankfully, that changed on the 6th of April 2015. So now, say for example, someone with a protected retirement age started taking benefits, say at age 40, you don't need to worry about a block transfer now. They can still make a transfer, a normal transfer, and they can continue to take payments, even though because they've started taking them already, because as long as they started taking them, they had the right under the scheme where it originated, you can still transfer that without having to worry about a block transfer now. So that is a little bit of good news. Couple of issues when it comes to protected PCLS, tax-free cash. Obviously, there's quite a lot of single member schemes out there, such as Section 32s. retirement annuity contracts where you might have a protected PCLS, but you don't have access to drawdown. They're annuity contracts. So yes, you have this benefit of more than 25% of the fund being taken tax-free, but then there's the only option to buy an annuity, which is maybe not in the client's best interest. Maybe that's not what they would otherwise do. Or may not be lost on these cases. It may be you don't have to make that choice between the enhanced tax-free cash element or having a drawdown. This is because of this statutory permissive override that we have. So when pension freedoms came in back in 2015, and well, obviously they were announced just a year or so earlier, it was, as we all know, a bit of a surprise at the time when it all came in. It was all very rushed as well. There's only just over a year between it being announced by George Osborne's budget and it all coming in. And because these changes happened very rapidly, there was this statutory permissive override written into legislation, which basically gives the right for any defined contribution pension scheme to offer pension flexibility regardless of what is written in the scheme rules. So no scheme has to have it in their rules to be able to offer flexi access drawdown. So what this means is that payments can be paid by the trustees or managers of a pension scheme despite any contrary provision in their scheme rules. And as we know, transfers have to be on a like-for-like basis. So what this means is that a scheme that doesn't offer drawdown doesn't have the facility to offer drawdown, so doesn't have in the scheme rules, doesn't have the functionality to do it. All they have to do is basically designate funds to draw down, and then you can do a like-for-like basis transfer to a scheme that can actually physically make the payments. And so that override is found in Finance Act 2004, section 273B there. And there isn't a reason why any defined contribution scheme can't do this, even if the rules say they can't. Don't do drawdown, and the system say they don't, they don't have the functionality to do drawdown. If they can, the trustees can be persuaded, which can be the hard part. Obviously, we can't. There's no way you can force a scheme to do this, but you hopefully, with a persuasion, you might persuade them. Yes, there's nothing that stops them from being able to do this, and particularly if it's in the members' best interest to do it, treating customers fairly. If they can do it, there's no reason why they shouldn't be able to do this. So in order to do a transfer, all the receiving scheme would need would be confirmation that the funds have been designated into flexi access drawdown in the member's name, the date the funds were designated, the amount of the fund that was designated. Technically, they need to put in their confirmation of whether the money purchase annual allowance was triggered. Now, we know that's always going to be saying, no, the money purchase annual allowance hasn't been triggered because, of course, they don't have the ability to pay any income, so it won't have been triggered. So really, any defined contribution scheme, needs to do is to provide that information there in the box, and obviously physically make the payment across to the new provider, because scheme rules, it doesn't matter. So if you do have any schemes in that position where they're saying they can't pay it, it's probably worth going back and questioning it, and you may need to sort of go up the chain to get the answer you want on this, but certainly it's important that Finance Act reference, if you ask them to have their techies look at that, then that might be helpful. Moving on to transfers and lifetime allowance protection. So most cases you don't have to worry about for clients that have lifetime allowance protection. It's not generally lost on transfer, because you are making a permitted transfer. So you're transferring to a registered pension scheme, a recognised transfer. That isn't going to cause a loss of protection. Primary and fixed protection you can't lose other than on divorce anyway. so you don't really need to worry about those. The only slightly grey area we have is with enhanced protection and to a certain extent fixed protection as well. If you are doing a DB transfer, we do sometimes have some questions around this. So where a defined benefit or cash balance pension rights are transferred to another money purchase arrangement, so you're doing a DB to DC transfer, the value of the sums and assets received by the other money purchase arrangement must be actuarially equivalent to the rights being transferred. So in most cases, they will be, it's an actuary who's going to have calculated the CETV, and giving you the quote on it, actuarially equivalent, you're going to do the transfer. That's not going to break enhanced protection. The question mark we get sometimes is when people say they have an enhanced transfer value from a DB scheme. If the scheme are paying an extra bonus or they're paying something extra above the transfer value, could that cause a loss of enhanced protection? And probably not quite as common as they used to be a couple of years ago, this enhancements to transfer values. But if you do find that scenario, it's probably just going back and checking with the scheme what they mean by enhanced. In most cases, they're probably just going to say, it's not the trustees have added something on after the actuaries have calculated it. That's fairly unlikely. It probably is following a standard, a normal actuarial practice, in which case then you're not going to have an issue with it. We have questioned this one, has some discussions with HMRC, and basically they've said if it follows normal actuarial practice, then it won't cause loss of protection. So, but if you do have enhanced values, you might just want to double check, get that in writing, get that confirmed. So generally speaking, that's the only sort of minor quirk where you really need to sort of worry on the enhanced protection for transfers. Moving on to the cheerful divorce, ill health and death questions. So first of all, when we're looking at transfers following divorce, earmarking or attachment orders. So this was the earmarking or attachment order with the pre-runner before we had pension sharing orders, which are much more common now on divorce. But there are still quite a number of pension schemes out there that have attachment orders on them, and this can cause problem if you want to make a transfer. They can cause problems in lots of ways, actually. The thing with attachment orders, earmarking orders, they were designed before anybody had dreamt of pension freedoms, and it means that when the member comes to take benefits, there is a certain percentage which will go to the ex-spouse. The problem with pension freedoms, of course, is that they don't have to take benefits at any point in time. The ex-spouse might not get anything ever. They have absolutely no control about when they get payments, timing, income, what the investments are, anything like that at all. Because of a lot of issues with attachment orders, a lot of providers won't accept transfers with them on. So, you need to be careful if you are trying to do a transfer where somebody's got an attachment order. Also, because they are so messy and they're just not designed for the pension world that we live in anymore, certainly on the DC side of things, it could be worth going back to court and get it changed to a pension sharing order. It's certainly worth considering, obviously depending on the value and what the relationship is between the, if the spouse, ex-spouse, if they still get on well, it might not be necessary. But in a lot of cases, it probably is worth going back or worth considering it and getting it replaced with a pension sharing order to allow the ex-spouse to have control and to have a clean break and all the advantages that we do have with a pension sharing order. That said, if somebody is going through the process of divorce at the point that they want to do a transfer, if there is a pension sharing order being put in place, but it hasn't all completed, it may be that you can't do a transfer for the original member. If you're advising on the person who's having the pension debit applied to their pension, that you may need to wait for the pension sharing order to be completed, the pension credit to go out for the ex-spouse before you can then move. If you don't, even if it's sort of earlier on in the process, it can cause problems when you get a pension sharing order that's coming. It's got the name of one pension scheme, but actually, in the meantime, the member's transferred to a different pension scheme, and the orders, the pension sharing order is referencing the wrong scheme. So really, it's much cleaner if you know there's divorce going on and there's pension sharing orders being in place. Get that all sorted and settled first, if possible. And then, do you transfer out once it's split? It's much cleaner that way. The ex-spouse obviously has to transfer out their pension credit under a pension sharing order. Now, it could be that transfer out is simply to a new arrangement within the same scheme. Certainly, we see that quite a lot when we have our members divorcing. The ex-spouse might set up a scheme with us. That's absolutely fine. Obviously, they can free to transfer out wherever they want to. They may have to, it depends on the scheme where they're in. If it's a defined benefit scheme, public sector defined benefit schemes, they will have a pension credit member for them to stay in that scheme, the ex-spouse. For private sector DB schemes, quite often they won't let the ex-spouse become a member, pension credit member. They will force them to transfer out. They have to go elsewhere. With pension credits, if you have a fairly wealthy couple who are divorcing, and so it might be that both of them have lifetime allowance protection. If the ex-spouse, so the person receiving the pension credit, has got enhanced or fixed protection, that would actually be lost if they set up a new arrangement to receive the transfer from the pension sharing order. So for the member who's having the pension credit, there's no issue with holding enhanced or fixed protection. And if, even for the ex-spouse receiving the credit, if they have enhanced protection and they transfer the pension credit into an existing arrangement, then that's absolutely fine. You're not going to have any problems. I say the issue would be maybe the ex-spouse has just got a big DB scheme, which is why they've got their protection in place. But it's a private sector DB scheme that's not accepting any transfers in. If they don't have another DC scheme somewhere that they can receive this pension credit into, so they don't have anywhere to put it without setting up a new arrangement, then obviously they've got a problem. It would cause loss of protection, and in that case you would really want to have thought about that before you've actually done the pension sharing order, before you've got the split of assets, because that's going to have a big impact. It needs to take it into consideration when we're deciding how to split the assets on divorce. There's no impact on primary protection or individual protection if you receive a pension credit. You set up new arrangements and things. Obviously, if your pension savings have suddenly gone up, it might be that the primary or individual protection isn't enough to cover your whole pension fund, like enhanced would do, but you don't lose the protection. If you want a bit more detail or anything about divorce and lifetime allowance protections, I did do a divorce webinar, can't remember, a few months ago. It is available on the website. There are technical ones, which I'll show you how you can access those. But there is more detail on that if you missed that one and it is something you're interested in. Okay, ill health then. So generally, we don't have inheritance tax on pensions. Not always, but certainly when there's discretion in terms of death benefits. But there are odd exceptions when pensions can be subject to inheritance tax. When it comes to personal representatives, doing all the paperwork on the estate, any changes to pension benefits within 2 years of death have to be reported on the IHT 409 form. Which that is an extract from that you can see there. So you can see, did the deceased within the 2 years before they died transfer disposable benefits payable under a pension scheme or personal pension policy? So obviously any transfer that you make in the 2 years prior to death has to be reported. Now, if they're in good health at the time of transfer, then you're not going to have an issue with it. It's not going to be liable for an inheritance tax if there's no reason to think, you know, that they were going to die at the point in time. However, if they were in ill health at the point they transferred and it was within those 2 years, it could be deemed a transfer of value for inheritance tax purposes. It is a lifetime transfer as well, which means there is no spousal exemption in most circumstances on that. So even if the death benefits are going to the spouse, it doesn't mean that they won't be liable to inheritance tax. There has been a bit of an update on this recently. I'm sure many of you will have seen, we had the Supreme Court ruling on the Staveley case, which has been rumbling on since 2006 when Mrs. Staveley died. My colleague Charlene Young did, I think it was just last month, did a webinar on pension, in IHT and pensions, and she looked at a bit more detail on the ill health transfers issue. Again, that's available on the website, so if you are interested in that, you want to know a bit more detail, then do go and look at that one. Moving on to death. So when somebody dies, death benefits are distributed. They can either be paid out as a lump sum or be used to provide beneficiaries drawdown that can be used to purchase an annuity. When we're looking at beneficiaries drawdown, it has to be designated in the current scheme before being transferred. Yes, rules say you can't transfer a deceased member's fund. So in the original member scheme, the scheme administrator has to do that designation, and then you can transfer to wherever the beneficiary would like to have that pension. It could be, you know, certainly, again, you know, with our schemes, you know, quite often they'll settle their own sit with us. It'll be an arrangement in their own sit with us, and it'll be down as beneficiary drawdown. They may already have a sit with us, in which case it's just another arrangement within their existing sit. That's fine as well. Important to remember, or it can be useful certainly to remember, the statutory permissive override that I talked about before applies to beneficiaries flexi access drawdown too. So again, if you have somebody that, a case where the member has died in a scheme and the scheme is a defined contribution scheme, but they're saying that your only option is a lump sum, or it may be, you know, dependent annuity, those are the only options, they don't do drawdown. Well, actually, if it's a DC scheme, they could do the designation to beneficiaries drawdown, provide the information to a new scheme that does offer drawdown, and then do the transfer on a like-for-like basis. So, you know, it can be worth remembering it in following death as well. That override can be useful too. On to overseas transfers then. So transfers to a CUROPS, a qualifying recognised overseas pension scheme. So a CUROPS is an overseas pension scheme that's broadly equivalent to a UK registered pension scheme, recognised by HMRC. They do publish twice a month their ROPS list, recognised overseas pension scheme, which is a ROPS list, not a CUROPS list that they publish. So it's still down to the provider you're transferring out from to do the appropriate due diligence to be satisfied that the scheme you want to transfer to is a genuine CUROPS. But we also have the added bonus of having the overseas transfer charge to contend with now, which came in on or after 9th of March 2017. And it really came in because I think people were abusing the CUROPS rules, you know, using it to transfer out when actually the CUROPS rules are designed, you know, for people that are genuinely moving abroad to take their pension with them, not for somebody just to, you know, try and take advantage of different taxes in different countries when, you know, you're still living in the UK, or, you know, you move to one country and your pension scheme goes somewhere else that's sort of got tax advantages. So the overseas transfer charge came in, transfers requested after 9th of March, and there's 5 conditions. And if you meet one of the 5 conditions, then you don't have to pay the charge. So the first one is if the member is resident in the same country as the cure-op. So if you're moving your pension scheme to move to the same country, you're fine, you don't have to pay it. One of them is if the cure-ops was established within an EEA country and the member is resident of a country within the EEA. So you don't have to be in the same country. You could transfer your pension to Spain and you're going to move to France. That would still be okay. The other conditions relate to international organisations, overseas public schemes, and if it's an occupational scheme. Do have a few questions about what happens obviously post-Brexit with this, and the short answer I think at the moment is nothing changes on it. The legislation with this rules in it, it's primary legislation, Finance Act 2004, which sets out the exclusions for residents of EEA states if the scheme is in an EEA state, so you don't have to be in the same country. So until that legislation changes, which would have to be in a future finance bill, then those rules aren't going to change. They're not going to change on the 31st of December because I say we need to change primary legislation separately via a finance bill, which hasn't happened yet. So I don't think there's anything immediate for you to, if you do have clients in that scenario. Clients that do move the pension scheme to one country and they go to a different country, which isn't an EEA state, and they're not, apart from that exclusion, or occupational pension schemes, etc., then they have this overseas transfer charge of 25% of the transferred value. Of course, in practice, you don't actually see many of those charges being applied because it's just too much to put people off. Just don't do it, which clearly is the idea. On these overseas transfer charge, it's the member and the scheme administrator that are jointly and severally liable. So you would obviously, the scheme administrator would withhold that amount from the transfer value. They would pay the balance across to the new scheme, to the cure-ops, and pay the 25% across to HMRC. We can see, but this has had a pretty dramatic effect on the total number and value of cure-op schemes. This is the latest stats from HMRC. We can see how the number of transfers, it was over 20,000 we had in the 14-15 tax year before these rules came in, how much that has dropped now to the last tax year, 19-20, there was just 4,400 transfers. So, quite a significant drop on cure-ops activity. So it's been successful in curtailing that if people weren't doing it for legitimate reasons. Okay, final thing I'm going to talk about in relation to transfers then is the statutory right to transfer. At the moment, we have the Pension Schemes Bill going through Parliament. This is one that started in the House of Lords. It's going through the House of Commons at the moment. It's at committee stage in the House of Commons, so they're debating it all line by line. Part of what they're doing under the pension scheme bills, along with things like pension dashboard and collective defined contribution schemes, is making changes to help prevent scams, particularly scams in relation to transfers, and making changes, as proposed changes to the statutory right to transfer. Now, the fine details of what that statutory right, the new statutory right, will look like won't be in the pension schemes bill itself. What the pension schemes bill is doing is giving the power to the DWP to write regulations in relation to it. So that's in the pension schemes bill, and then we will see the follow-up from DWP under SIs, so secondary legislation that will come out later once the pension scheme bill is passed, which is expected to be before the end of the year, calendar year. But what changes are being suggested? What do we think is going to happen? From the debates that we've had so far on this in Parliament. So one of the key ideas seems to be that the statutory right to transfer is going to be restricted, possibly to an approved list, which would be sort of FCA recognised schemes providers and master trusts. So there will be a list which would have, you know, yes, the statutory right would still apply, but then there would still be, doesn't mean you can't transfer to schemes that aren't on that list, but there'll be a bit more of providers' discretion about it. So also talk about when you're doing transfers to occupational schemes. So there may still be a statutory right, but there will be a lot more questions being asked, and this evidence needed to demonstrate the employment link. So it will be, you know, people asking for things like pay slips will be obvious, like, you know, going back a few months, not just, you know, a one-off. A lot more evidence that will be required, especially when you're thinking about SASs is an obvious one there. There's going to be a lot more questions, I think, asked on that. There's also talking about putting pauses in. So there'll be certain, if there's certain red flags, that trustees will have the right to be able to pause a transfer, you know, without that, you know, counting against them, if you like, you know, in terms of the delaying a transfer. But if there's certain, you know, flags that come up, that there'll be more powers for schemes to be able to stop or you know, delay transfers where they have concerns about the scheme coming in. So yeah, we'll wait and see exactly what those regulations are when they come out. To say it won't be till next year, because after the Pension Schemes Bill, the primary legislation goes through, then we'll start seeing something from the DWP. But yeah, just to be aware that that one is changing. Okay, so that's all I'm really going to say on the subject of transfers. I've mentioned a couple of times about other webinars and things available for you. A couple of months ago, we changed the look and feel on our website. Hopefully some of you have been on there and seen it, but I just wanted to have a look a little bit about the Investcentre and sort of help you know what's on there, so you're aware of it really. So this is, you don't actually have to log in to get into this bit. So if you go onto the Investcentre website, if you click first of all on support at the top there that I've circled, and then on Investcentre, then you will get this Investcentre come up. But there's a couple of ways that you can search on here to get the information that you want. There's a drop down just below there which has this filters box. You can either use in the top right there, there's the search function. So obviously you can just type in whatever subjects. You could type in transfers and hit search, and it'll bring you anything that we've got on transfers. You could go on the technical content if you wanted to apply a filter and say, okay, I just want something on, could you use transfers there? You could tick it there, or any of those subjects there. You don't have to use the filters. You can just use search, or you could just use the filters. And that's fine. On the type over here, we've got video. So if you didn't click anything else, if you just clicked on video and apply filters, that would bring up all our videos, which includes all the webinars that we've done in this technical series, which we started back in April. So there's quite a lot of them on there. If you wanted to go and find any of those. Or what else we've done is with most of these webinars, we've also produced a guide that goes with it on that subject matter. So if you just clicked on the guide, if you just tick that box and then hit the apply filter at the bottom, you would get something that looks like this. It might look slightly different because by the time you hit on it, we might have written some more. But it shows you the results there, and you can see all the different guides for different subjects that we've got on there. So we have got quite a lot of material on there. So may be useful, and I say you can get all the old webinars on there. Got all these guides. There's lots of articles and stuff we've written in the press. And there's stuff on the investment side. Of the investment guys have done webinars as well, not just the technical side of things. So yeah, please do have a look around there. You can see there's a little feedback tab as well. Tell us what you think. Also, we're always interested in, if there's any subjects you want us to cover, please do let us know, and we'll see what we can do on that. So thank you very much. Just going back to the subject of transfers, just to round up then. As we've looked at, there's many reasons to transfer. You do need to be careful with protected benefits. So I'm thinking really scheme-specific protection on that. The need for block transfers. You need to be very careful with those transfers. Generally speaking, lifetime allowance protection, you don't really have too much to worry about on that. Statutory override can be useful. So if somebody says, if you're in a scheme and they say they don't offer a drawdown and it would be in the client's best interest to have drawdown, and it's a DC scheme, it's probably worth going back and not just accepting the first answer, questioning that a bit. And yeah, looking at the statutory right to transfer is likely to be changing, so we'll just keep an eye out for that one. But that is all from me. So thank you very much for your time. If there are any questions, feedback at the end, you'll get sent out. My colleague will send you out some information anyway. If you have any questions, myself or my colleagues will come back to you. But thank you very much and goodbye.